our technical support person will provide some guidance on how to uh, listen in on the audio version, either through your phone or through your computer if you're equipped with that. This is Ron Gallagher at PAMIC, and we're happy to bring you the Virtual Insurance School Session 2, Insurance Policy Fundamentals. This will be a little bit shorter than the first one, but with the first one, I do have to apologize that we were cut off at the last 10 or 15 minutes of it. Apparently, Comcast Internet decided not to work for us at the last 10 or 15 minutes. It took a little while for us to figure that out, but we apologize for that. We did post the slideshow and the audio version on the PAMIC website. It's under PAMIC Events, and then you can work your way to where the information is located. With that, I want to introduce Jack Yanoski again. Jack is a good friend of mine from many years at the insurance department, and well-versed in all forms of insurance. I think I may have mentioned to you last time that he started out on the life side, worked in the compliance area for an insurance company, and then came to the department and managed the Erie office for a couple of years. And because he was so good at what he did, we brought him to the Harrisburg office as the lead supervisor in the consumer services operation. And then I hired him to run the Bureau of Licensing and Enforcement, where he was really a key part of my team. So with that, Jack, I just want to say welcome again, and thanks for bringing some better weather with you.
Hey, thanks, Ron. Great to be here. We're going to go over probably the easiest of the four sessions that I looked at, snooping on the websites. This one is about insurance policies and actually what they are. And really, in the short of it, insurance policy is nothing as a contract between the insurance company and the named insured. Most policies, if not all, are just made up of several different forms that attach each other, not one being the policy, but the compilation of the forms become the policy. Typically, the application is not part of the policy in the P&C side of the fence. And I'll explain that a little bit why a little bit later. But in a life insurance policy, now I know that you folks don't really deal with it, but you probably have it in some format. In a life insurance policy, the application actually is part of the policy in Pennsylvania. But in the P&C side, no, it's not. And what you have really in the first portion of the policy is the declarations page or the declaration sheet, or as you know, you get comfortable in the marketplace, everyone just calls it a deck sheet. And what the deck sheet is the insurer industry. The insurer prepares basically the synopsis of the application. So when you look at the deck sheet, it tells you who's the named insured, where the coverage is, how much the coverage is, what it's covering, policy terms, periods, and the premium. So it's basically just a regurgitation in a simplified form of the application. That is the deck sheet. Then following the deck sheet in most policies comes the ins and outs, if you want to call it that, the insuring agreement. This is where they'll put some definitions in there. You is the insured, and we, the insurance company, and they define the terms. And the insuring agreement, and it specifies as to what the coverage will be, what the company will do, and what the obligations, if any, of the insured, usually just to pay the premium, and agree to comply with the terms under the conditions section, which is the third section. The conditions set out under what terms coverage can be affected. So if there's a claim, you always have to go back to the policy. The first thing you do, you look at the deck sheet, then you look at the insuring agreement, and then you look at the conditions. And then finally, the way a claim should be handled. And this is coming from both my time in the insurance industry and my time at the department. The way a claim should be handled is the claims person should be attempting in good faith to the nth degree to pay the claim under the terms of the policy. Only when it is discovered that the claim does not meet the conditions of the policy, either through an exclusion, the last set of pages it's usually attached, or the coverages just isn't there, should the claim be denied. It's not advantageous to say, well, just up and deny the claim because of this or that. They should find every means possible to pay the claim, and when they exhaust it, then they should deny the claim. So those are the four actual forms, if you want to call them forms, that make up a policy: the deck sheet, the insuring agreement, the conditions, and the exclusions. And then there are other forms that can fly along, and since the company's under the PAMIC flag or mutual, there'll probably be a set of pages in the miscellaneous section that'll set out like voting rights of the policyholders, some other terms for the company, dividends, if any, to be paid, how they're paid, things of that nature. Those would be in the miscellaneous forms. They're not in every policy, so they're not the four basic forms that come in, but they would be in many mutual companies would have that, or a stock company that does offer a dividend type policy. They would have the same types of forms on how they're going to set out and do that. So that basically grabs the, highlighted the first part. What is an insurance policy? It's a contract between the insurance company and the named insured. It's drafted by the insurance company, so it's an obligatory type contract. So when there's usually a dispute that goes before the court, there's a high bar for the insurance company to meet its defense if they're denying payment or something, because they drafted the contract. All the insurer did was sign and pay the premium and agree to the terms. And as long as he feels that he met those terms, the insurer should pay. So that is one of the differences between an insurance contract and a contract that you may negotiate to have your roof put on, or even in buying a car. There's you're making the loan, but you're sort of drafting the loan, telling them this is what I want, this, and this. In an insurance policy, this is what you get for this coverage. Like in a homeowner's policy, there's different coverages, A, B, C, D, E. And they're usually standard. And that comes down to there's different types of policies. First is basically a modular type of policy, which is a modular. You think about it, it's composed of multiple units. A good example of a modular policy is a homeowner's policy. Homeowners insurance policies provide first and third party coverage. That's why they're modular. On coverage A and B, which is dwelling and appurtenant structure, and then there's C of contents, those would be first party claims, that if there's a fire in the home or hail damage or some other damage to the dwelling, that the homeowner makes a claim. If there's a contents damage or a theft of contents, the homeowner makes a claim. However, if you're cutting your grass as the homeowner, and your mower throws a rock and damages your neighbor's house, you can have that paid under the liability portion of the contract, and your neighbor would now be a third-party claimant. Now, as a hint and an aside from my experiences, if you did that and you knew your neighbor real well, and your neighbor has replacement cost, it would benefit your neighbor to go to his own insurance, file the claim under the replacement cost, and have his insurance company, if it's different than yours, subrogate back to yours, because then his home is repaired at replacement cost. If it's paid under the liability of your policy, it's going to be paid under actual cash value. Liability is always paid under ACV. The company can be nice and say, yeah, we'll put all new siding on and don't worry about it, but they don't have to. They can take depreciation. But if he goes to his own carrier and he has replacement cost on the dwelling, it'll be replaced that way and they can subrogate. So that's just a little aside for the claims people. You can't actually tell somebody to do that, but you can make suggestions on how they can obtain the most for the claim. Personal auto is also a wrapper or modular policy because it provides for medical payments, liability, and damage to your own property. Now, here again, working, as Ron said, in consumer services, we always fielded a lot of calls. It's not an insurance law that you have to have motor vehicle financial responsibility or personal auto, is what most people do. It's motor vehicle code law. The insurance laws in Pennsylvania do not set out any requirement to buy any type of insurance, auto, life, home, whatever. Not the insurance laws. Other agencies may have requirements, like the Department of Labor requires employers to provide workers' comp. The PennDOT requires financial responsibility on vehicles that are registered for highway use. So those agencies have the laws. The insurance department has the product regulatory effect and will outline in their laws how the policies may be terminated and will control the rates in the personal side. But we do not say that somebody has to buy it. But those are two types of modulars, and I think the example given in the outline was workers' comp. And for years, workers' comp was thought to be a health policy, which is kind of funny. It's not. It's a liability policy, actually, of the employer. And the theory behind the workers' comp is that if you're injured at work, you do not have to sue the employer for any negligence or anything to recover medical bills and lost wages. So the workers' comp kicks in. It pays disability pay, it pays health bills, and in the event of the death of an employee in a work-related accident, it would pay a death benefit. So it's a modular policy. It has life, health, and disability pay.
Hey, Jack, before you go on, I just want to let our audience know that they can ask questions throughout the presentation. And the easiest way to do that is through the chat feature. You'll have 3 green bubbles at the top of your screen. One has looks like an actual bubble itself. And if you click on that, you can send a question that everybody can see, or you can direct it to technical support or to questions for the VIS. That's actually me. But I do have a question for you, Jack. Earlier, you used a term, a very technical term, that took me a while to fully understand, and that was the term subrogation. So could you explain to us what subrogation is?
Sure. Subrogation is basically a proceeding where if we're dealing between two insurance companies, the insurance company that pays the claim for the loss will file an action against the insurance company or the individual that's a tortfeasor for the claim. So in the example I gave, you're cutting your grass and you throw a stone or something and it breaks the window or damages the siding of your neighbor's home. If the neighbor's company pays the claim, then they will file an action against your insurance company to recover the money. They actually file it against you. Your insurance company will then respond and pay it. So subrogation is an action between two insurance companies. It would be similar to if there was no insurance at all involved and you took someone to court suing them for damage they did to your property or whatever. But in the insurance market, the subrogation is just between the two carriers or multiple carriers if there's more than one at fault.
Well, thank you.
Okay.
I do have one more question. So you've been going over the declarations, definitions, insurance, exclusions, conditions, miscellaneous provisions. What role can an insurer just create these documents and market them to consumers, or is there some type of oversight that has to go on? And if there is, are there different levels of review that have to go on?
Right. If the forms are insurer specific, the personal lines would be filed with the in Pennsylvania would be filed with the department's Bureau of Office of Rate and Form and Policy Review, and they would review the forms. Insurance companies can do that. That's, you know, their call. Most companies will go to one of the vendors, for the lack of a better term, to the Insurance Services Office. ISO forms are popular. And what they'll do is they'll create a standardized form that the department has no problems with, and the insurer then can just use that form without having to file it separately with the department, basically putting their logo on it. And then if the insurer wants to alter that form after the fact in some manner, they can use an endorsement, an mandatory endorsement. The endorsement would then be filed with the department only, not the entire policy itself. So there is a review on it. The compliance portion of that is to assure that, one, the policies are easy to read, and two, that they do not cross the line and violate the laws in any manner through provisions, exclusions that would fly in any of the primary categories: discrimination by age, race, sex, religion, and employment, and the typical anti-discriminatory rules. But and that forms would be easy to read, and it's been quite a few years. It's going to have to be at least 25 or 30 years ago. Pennsylvania enacted the requirement that all of the policies basically are written somewhere between an 8th grade and 9th grade level. They're not difficult to read. What the animal in the forest is people think they are, so they don't want to read it because it's like, oh, it's complex, it's insurance, and that's what agents are supposed to do. I was an agent for 19 years and probably only read one of my policies, and that was my homeowners, to find out what I had here and there. Most people don't read their insurance policy until there's a claim. It's not a good time to read it, true, but most people don't because, one, it's believed to be complex. Two, we're just busy. And you get the new deck sheet when it renews. You get a premium notice when it comes in for a life policy or a health policy or a quarterly premium on an auto or homeowners, and you pay it and you go on. And if you have a question on it, you call the agent. And that's what most folks do. But yeah, the policies are written between an 8th and a 9th grade level. They're not complex.
Well, I had a question. Now, if a company files a request for approval of a form, is there something within the insurance law that allows for automatic approval by the insurance department if the form is not disapproved within a certain time?
What Vince is asking is the deemer provision. A number of years ago, I don't know, maybe back in the late 90s, Pennsylvania enacted what became as a 45-day deemer. So when a form comes in, the rates and forms folks have 45 days to review it. If they find something that's problematic in that 45 days, they tell the company what's problematic with it. And that doesn't toll the deemer clock. It goes back. The company has to make the correction and send it back in. If the department does nothing for 45 days, it's very similar to executive privilege. The governor doesn't have to do anything with a piece of legislation that's sent to them. They can leave it go, and on the 11th day, it becomes law. On the 46th day of a filing, if the department does nothing with it, it's deemed approved. Okay. Now, what can happen, and it may happen, is if a form slips through and it shouldn't have been approved, because it is human error, they miss it, and it's discovered. It can then be dealt with after the fact by telling the company, hey, this is really out of context. We should have caught it. We didn't. You need to fix it. And of course, once the company's put on alert for that, if the company refuses and continues to form that actually does fly in the face of the law, the department would have to ramp up its enforcement areas. But typically, most companies are sophisticated enough to know, hey, if they made a mistake and they tell us, and they give the cite, you just can't tell somebody that it violates the law. You have to actually tell them the citation in the statute that's where the document, the provision, whatever you're dealing with doesn't cross it. But yeah, they do, if they don't do anything for 45 days, the form is considered approved.
Well, that kind of opens up another question. I know on the life side and the disability income side, and to some extent long-term care, there's the Interstate Compact that says if the policy has been approved in one jurisdiction, it's approved in others. For property casualty, is there any sort of reciprocity with other states, or if the form meets the NAIC requirement, then is it deemed okayed by the Pennsylvania Insurance Department, or must there still be a formal form review process?
Well, I can't say with 100% accuracy that there's the P&C forms aren't on the Interstate Compact, but there are life forms on the Compact. P&C is kind of tough, okay, because you have different risk acceptance, okay. Like last time when I was talking, you know, it's unlikely that they're going to have a roof collapse in Louisiana from weight of ice and snow, which could become a real reality here in another 2 months in Pennsylvania. Just like, you know, a tropical storm hitting western Pennsylvania is probably going to really have to take some hurdles. So approving one common form that the P&C carriers could use like that would be a little more difficult. The term life one isn't. I mean, you know, life is fairly uniform across all 56 jurisdictions. But not to say there isn't one boiling out there. I retired from the department last June, and something could have happened this year, but when I left, I didn't think there was.
So that was a good question, because this new term came up, Interstate Compact. And in the P&C world, you don't hear about it very, very often, if at all. But in the life and the long-term care arenas, it's used a lot. And it's as the questioner said, that this is a way where an interstate compact is created, where states agree to membership in the compact, and the compact then makes the forms approval and rate approval not rate approval, just forms approval for the forms to be sold in Pennsylvania. So in essence, there's an arm's length regulatory role that they have. And in Pennsylvania, when there was a law that was passed at the request of the department to allow us to join the Interstate Compact, because the benefits to the industry are they can file one form with one entity and use it in all those other entities. So it's called speed to market. You're able to get your products to market faster than if you had to go to all the jurisdictions that require prior approval on the forms.
That is correct. I'll give you a horrific example. In the early 80s, it was around 1981, the company that I was with, the multi-lines company, life, health, auto, home, life, health, P&C. And they began to develop into the investment markets. So we had to go down to then NASD, now FINRA. We had to get our registrations, and some of us sort of like failed miserably, so we were taken into compliance, and we started to put it in training. But around 1982 or 83, the company filed in all 50 states, DC, the 51 major jurisdictions, a policy form, a life policy, and it had two different variants for operational effect, basically A and B, okay? And every state within 60 days approved A. B was not approved in Pennsylvania when I left the company in 1994, and it was the only state that hadn't approved B. Whatever reason, of course, we didn't have the Deemer then either. So that's where the Interstate Compact can come into play and be very valuable. There was nothing wrong with the document. The insurance department folks just didn't like the way it was structured, and it was actually structured for more cash accumulation than it was death benefit accumulation, so they were saying that truly it's not insurance, but okay. Long and the short of it, one state in 51 jurisdictions 12 years later hadn't approved the one thing. Had that been on the Interstate Compact, in which Pennsylvania would have been part of, it probably would have been done within the first 60 days, like the majority of the states had done it. So that's an example where speed to market can actually help, because the product was there. Apparently, it had no other problems. So on that, in the long-term care, they're fairly uniform documents, and the claim is going to be here or there. On a life side, the claim usually occurs in one of three methods. Either the insured dies and beneficiaries make a claim. The insured, if it is a cash accumulation, lives and cashes it in and makes a cash claim. Or the insured becomes disabled, and then one of the other two will kick in, but there's waiver of premium may come in and pay the premiums for them. So usually that's what happens to a life policy. P&C, well, they work on their own. But like I said, P&C being a little more complex on things, you might not see it on the Interstate Compact. Now,
Okay. Are there any other questions from our audience? If you do, please use the chat function to ask them, and we'll provide them to Jack.
okay.
Next one. You need the next one.
The next slide. Yeah. Okay. Policy analysis. Basically, 90% of the time, policy analysis is done by the producer. In the pre-loss policy analysis, what you have, a lot of times that's done at the point of sale. It's where the producer, or if it's a direct right, the person is dealing with the proposed insured for the coverage they need, so that if a claim does arise, coverage will be there. That's the pre-loss analysis. Pretty simple. If you're dealing with an automobile, you got a brand new auto, you're going to want physical damage on it, how much liability you're going to want on it, under our Act 6, whether you want the uninsured, underinsured motorist coverages, those are all, and all of that is determined at pre-loss, so that should there be a claim, you have the coverage. Post-loss policy analysis usually occurs in the claims area, not usually done by the producer. Producers have to be very careful what they say when you go in and say, hey, this just happened, whatever, that they don't inadvertently imply there's coverage when there isn't. That tends to irritate claims people. But post-loss is usually done in that manner. One of the things you have to be very careful of in post-loss policy analysis is that you do not actually conduct post-claims underwriting. Post-loss analysis is basically going back into the policy, grabbing the deck sheet and the application, make sure that they match, looking at the conditions, is whatever triggered the claim, is that a covered condition? And if it's not, is it there by exclusion, or is it there because it's just not covered? That's what you're doing, but you want to be very careful you don't go into what we call post-claims underwriting, because that will draw the ire of the insurance department. You're supposed to do the underwriting before you issue the policy, not after a claim's been incurred.
Could you give an example of post-claims underwriting?
Post-claims underwriting, you would go back and you're looking for misrep on the app. You're looking for things that you should have discovered, or a condition that existed that you would not have issued the policy for, but you just didn't do it. And now you're trying to come up with the concept, had we known about it, we wouldn't have issued the policy. So you're actually looking at what we would call a rescission effect. If it truly couldn't be discovered, somehow it was concealed, and the insured knew about it, they should have disclosed it. But if you're looking at, I just give you a broad example, you typically do not write a home that has a wood burner in it. And on the application, it says, yes, there's a wood burner, okay? The underwriter issues the policy. Now there's a fire because it's winter. And you say, well, when did they put the wood burner? Well, they had the wood burner. Well, we shouldn't have issued the policy. That's post-claims underwriting. The underwriter already had the information and ignored it. You can't go back now and say, well, we're not going to pay the claim because we don't write homes with wood burners. If the insured concealed the fact they had a wood burner and the producer didn't know it, and there's a question that says, is there any wood burning devices? And they answer it no. Well, now you have an issue that was concealed, and since you didn't have access to the interior of the home, you probably didn't know they had one. But if it's asked and told, it's the old ask me no questions, I'll tell you no lies. If the underwriter doesn't do their job, you can't go back and re-underwrite the thing to avoid the claim after the fact. But if you were looking at post-analysis, it's, okay, well, we do insure them with the wood burners. Okay, now what's the damage is done, and how much damage is done, what's done to contents and things of that nature. And now, in the broad sense of the analysis, do we want to change our underwriting guidelines concerning wood burners? Because last winter in 2015, we had 17 homeowners claimed it involved wood burners. Maybe we want to do something in the analysis of that. Okay, so the analysis takes effect for future underwriting, where post-claims underwriting isn't oftentimes a methodology employed to evade the claim.
Jack, in Pennsylvania, especially for property writers, and most of the mutuals are property writers, there's actually a grace period in law for companies to do pre-loss policy analysis. But you have up to 60 days after a new policy is issued to take a harder look at the risk that you're writing, and you can then, if I recall, cancel that policy for any valid reason other than the ones that are protected under the Unfair Insurance Practices Act.
Right.
Is that correct?
Well, not 60 days after the policy is issued, 60 days after the application is made. On the 61st day, then you cannot use the 60-day terminations. Okay, so during the first 60 days, you could jump off a risk and say, the wood burner's too close to the wall. You have to fix it. But yeah, for the prescribed discriminatory reasons, you cannot get off. But during those 60 days, you have the right to jump off the risk through underwriting for reasons that pose a risk of loss that you typically are not structured for. Now, one of the things that an underwriter can do, and this was something I used to teach the underwriters to do, if there's a condition there that you'd like to write the home, but there's a condition there that you would like fixed, okay, the way the law is written in Act 205, and I think it's Chapter 59 is the regs that tie to it for termination. You can send a notice on, say, the 50th day, and you can basically say the risk is unacceptable. However, if you put a railing around the porch or around the deck, or you do this or you do whatever one piece of the puzzle that you're not liking to fit, if you tell them to fix it, you can rescind the notice. However, the way you word it is, if you were doing it now, I mean, we're in winter in Pennsylvania, so if you were saying, okay, today is the 55th day, there's no way they're going to get a railing around that deck and down on those steps in the heart of winter, especially if we're in areas where there's some snow. No one's going to do it adequately that fast in 5 days. So you send a notice today telling them that the policy cancels on May 1st of 2016 unless they comply with the following recommendations. And you spell out the recommendations of putting the railing around it. That meets the requirements of the law for the 60-day notice, but it also gives them time to correct the deficiency. Okay, there's a lot of underwriters that don't know they can do that. They think that everything has to be corrected in the 60 days. Now, that's not what the law says. The law says you have to issue the notice in 60 days, not the issue, but doesn't say you can't make a condition of recommendation.
And there is a whole, whenever you issue a cancellation notice, even when it has to do with this issue of trying to correct a deficiency, there's a right for the policyholder to seek review from the department. It's a mandatory notice you have to give. And the department then holds a hearing and ultimately adjudicates the claim that is made. The department actually has a digest of decisions that goes into great detail on various issues that have arisen. Fortunately, PAMIC has a subscription to that, and it's available on our website under the members only section on the regulatory area. And you can see Act 205 homeowner/property terminations. There's also the personal auto terminations as well. And there's another section dealing with agent and agency terminations. So that's a resource you can look at as you're looking at new underwriting issues and or other existing policy holders.
Right. Yeah, and the agency termination law that Ron just referenced is called Act 143. So they'll be in there as well for agency appointments.
Well,
Right.
I am confused though, in that if the policyholder conceals something that would have resulted in a non-approval of the application, for example, having a rather large animal with teeth.
Okay.
So in that 60-day period, the insurer finds out about this dog and says, okay, we're gonna cancel you. Does the policy holder still have the option to request a review by the insurance department?
Yes, in every case of a termination of auto and homeowners, the form has to identify the insurer, has to identify the date of mailing, has to identify the date of termination, and whether it's being kicked out on a 15-day notice, 30-day notice, or 60-day notice, cannot count the date of issue of the notice. So you're going to either have 16, 31, or 61 days after that date in which the policy will terminate. That has to be there. The reason for the termination has to be there. Whatever that reason is, misrep, we don't write this type of dog, whatever. And then there has to be a script that tells them they have the right within, now on homeowners, 10 days, auto, 30 days, to send that notice to the office of the insurance department. And since we're down to only one office, prior years, it would have had all four. When we had 4 regions, it would have had to have the addresses for each regional office, but now it would just be to the 1209 Strawberry Square, Harrisburg office. And then it must also, in the case of a homeowner's policy, have wording that they may be able to obtain coverage under the FAIR plan. On the personal auto, would have to be language that they may be able to obtain coverage under the assigned risk plan. All of that has to be on the notice. That's required information. So even if the named insured is totally out in left field, they concealed facts, total clear misrep, they still have the right to have the department review it. What the department will then do, it'll go to the Bureau of Consumer Services, an investigator will review it, will review the notice requirements, make sure that all of the required information is on the notice, and then they will issue what's called an investigative report order. And in the IRO, as they're just known as, it will either uphold the insurer's action to terminate the policy or reverse the action of the insurer and order the insurer to extend coverage. Whichever party is aggrieved, either the insurer because they're ordered or the named insured because the department upholds, they will then give them specific information on how to appeal to the administrative hearings office for review there, okay?
But I still have a question though, and that if I understand you correctly, the right of the policyholder only extends to the ability to request a review. It doesn't mean they're going to get a review.
No, they do get the review if it's timely, okay?
But when you said they have the right to request a review, that's not the same as saying they are guaranteed a review.
Well, they're guaranteed a review if they send the form in.
Okay.
Okay. They have to take the proactive action to send the form to the department. if they accept the fact, they knew they concealed something, whatever, misrep, and they decide not to go to the department, then they don't get a review. But if they send it in, even if they're totally out in left field and totally incorrect, and the insurance company is 100% accurate, the Department's Bureau of Consumer Services will review the termination action. That's why it's so critical when they send that notice be totally in compliance. Because if the company terminates the policy and it's a proper termination, but the form is non-compliant, the company's in violation of the law for using a non-compliant form and has to go back on the risk. Now, here's the catch. They terminate the policy in the 50th day. They send it to the named insured. He gets it 3 days later. That's 53. Named insured sends it to the department. Department gets it. Now it's 57th day. Department reviews it on the 58th day. Okay. 59th day, they mail the investigative report order out. It's not received till the 62nd day. Guess what? The company can't use another go-around of that notice. They're beyond the 60 days.
So is there an automatic tolling, though, of the cancellation, assuming that the insured has filed a request to review? Does that suspend the cancellation, or
only
make
if
cancellation proceed, and then retroactively be reinstated should the department rule in favor of the policyholder?
If the termination date hasn't crossed, okay, so when they send it in, the termination date, we'll just use today. Company sends a notice out today, it's January 7th. If it's a homeowner's, it's going to terminate February 8th. Date of mailing is today, so it's going to go from January 8th to February 8th, okay? February 8th. Person gets it on Monday and sends it to the department. Department looks at it next Wednesday, says, oh, wow, form's totally out of compliance. It's missing the fair plan language. It doesn't have the date of mailing, whatever. Just totally out of compliance. They order the company back on. Risk stays in effect. Everything's copacetic. Everything's correct. They don't write that type of dog. They don't write homes with wood burners, whatever. Everything's accurate. Department issues the notice next Wednesday that the cancellation stands. It dies on Feb 8. The department does not have the authority to extend the cancellation date unless they find a deficiency and order the insurer back on the risk. Right. Okay.
I do have one other question, though, relating to that.
Okay.
In terms of a claim, let's suppose the insured did not reveal the existence of the dog, and there's a dog bite claim. Okay. Am I understanding you correctly that claim will be paid by the insurance company? Now, the company may choose not to renew the policy, and that's their option. But does that claim have to be paid, even though it's for a situation where the insured did not reveal the existence of the dog?
Well, there's two answers to that. Okay. First, if the insured concealed it, and there was no question on the app, they didn't actually conceal it. But if they're asked if they have any pets, and they say no, okay, and the company doesn't do any more, the agent doesn't check it, they don't ask for any photos. I mean, if you go to the house, if they're supposed to send photos and you go to the house, the agents should see some type of sign that there's a pet there. But if they don't, then the claim would have to be honored, unless the company can prove that the concealment was intentional, totally intentional, basically one step from fraud, and they can rescind the policy. But if they can't rescind the policy, then there's coverage in effect to the date of the loss. Okay, that's the first one. So the second one is if they can rescind the policy, no, they can deny the claim. But if they can't rescind the policy, even if they don't have knowledge of it, but they could have had knowledge of it, then they're going to have to pay the claim. Yep. Okay. And of course, in the last section, this is determining amounts payable. Well, that's pretty simple. I mean, if you limit the policy, or if, somebody's, big screen TV is damaged and it's destroyed and there's $1,700 and you have replacement on the contents, and they go out and they replace it with a $1,700 or but it costs $1,900 and it's the like, kind, and quality, then that's the amount payable. So the amount payable is really not an argumentative issue. It becomes down to what's the value of the loss, what's the value of the property at the time of the loss, and what triggers the conditions. Is it replacement cost? Now, what a lot of consumers don't understand, and this is where both the producer and the claims person could do a little bit better job of explaining it, because I know I used to try to explain it on behalf of the producer or the claims person when the person called the department. When the claim is initially paid, it goes on ACV. So you have actual cash value, right? So you have a $1,000 TV. We're going to do this real simple. $1,000 TV. It's 5 years old. It's 50% depreciated. You're deciding you're going to, change some furniture around, and wow, you just put something through the screen of the TV and it shatters. Okay, so you got a 5-year-old. So you file the claim and you go in and you say, okay, yeah, well, we're going to pay the claim for you, and you give them $500, and they say, well, it cost $1,000. At that point in time, you say, we're giving you the $500. That's the actual cash value of this aged TV. But once you replace it, we will pay you up to the amount of life-binding quality. So if a new one like that now is $1,400, we will give you up to $1,400 when you buy the new TV. If you go buy a $700 TV, you get $200. If you don't do anything, you keep the $500 and put it in your pocket. But you have to be able to explain to them, because when they get $500 and they already know it costs $1,400, they're going to make a phone call to the insurance department, or they're going to send a letter to the insurance department that they've never been treated so shabbily. And I'd love to be able to read some of those letters if I could ever hijack the files. But the point is, determining the value, the insured is going to want the most value. And when you can't pay that value, you have to tactfully and professionally figure out some way to explain it to them. And I will tell you what I was told in 1975 when I began my career. Premium payers pay too much. Claimants never receive enough. Keep that in mind, because eventually, if you stay in the business long enough, you're going to cross both paths, and there may be one and the same person. So.
Going back on the determining amounts payable, let's get into a situation where a homeowner decides to underinsure their house. How do homeowner policies treat that consumer in the event of a loss? So I'll give you specifics. So let's say the rebuild value of your coverage A limit is estimated to be $100,000. They decide, since they own the house outright, there's no mortgagee, there's nothing like that. They decide that they only want to cover $50,000 of it. How does that work? And is there a scale at which a policy changes from replacement value to actual cash value?
Well, yes, there is a schedule, and that depends on the company. Some companies will file and say, to have replacement costs in the dwelling, you have to insure for at least 80% of the replacement value. Others will say 100. My homeowner's policy says I have to be insured for 100% of the value in order to maintain replacement costs. But then if it costs up to 125% to rebuild my home, I don't pay anything out of pocket. So there is typically, when you go below anytime you go below the 80%, even the nullifies the replacement cost provision, because that would go back to the conditions in the policy. The conditions page is going to say for replacement cost to be there, you have to insure at whatever percent, 80% of this, 90, 100. Once you go below that, you invalidate that coverage by that condition. And then the $50,000 claim is going to be settled on actual cash value. So if that house is 20 years old, you may end up with a $35,000 claim. So the other side of the coin, and I don't know how many on this course would be producers, okay? As a former producer and knowing producers, that presents an E&O claim for you, okay? So be cautious of that. Whenever you have an insured come in and say, the example like Ron gave, well, my house is paid for now and I know it's worth $100,000, that's what we have it insured for, but I want to change it to $50,000. Before you fix up that amendment to that policy, you better document that file extremely well that you did everything in your powers, because if they have that loss and get 35 grand, the first thing they're going to do is run down and say, he didn't tell me the ramifications of this. And it's lawsuit time, and E&O will kick in. And your E&O carrier is just going to smile to high heaven when they get that claim in front of them. So be advised, your job, and even if it's a direct right or the company deals directly with a consumer and they have a licensee at that end, you're opening yourself to possible litigation when you don't dot every I and cross every T to avoid a person nullifying their replacement cost provision and entering into an actual cash value depreciation area of loss.
But isn't valuation part of the field underwriting or the pre-loss policy analysis?
It is, and that's why I'm saying the producer has to be very cognizant of that. They're doing that pre-loss underwriting. An insurance producer actually is a field underwriter, you know. But so what they're doing is analyzing the data, and if they know the house is worth 100 grand, they should do everything they can not to insure it for 50 grand, because they're opening themselves in a can of worms if there's a loss, and they need to document that. How they go about doing it is one thing, but you should always try to give them the best advice and keep that coverage in compliance, especially when you're writing the policies that have those provisions in them. You know, you're really walking on thin ice when you go down that road.
But what if there is a set valuation based on the assessment value, something like that, and the property owner wants to insure the house for more than that? Is that something that the company underwriter would say, no, we're only going to give you coverage for 100 because that's the assessed valuation?
Well, typically what they'll use is one or two or three different formulas to come up with, you know, current construction costs. The home evaluators, they're pretty good at it, you know, and they're the other side of the coin, both from compliance, and since I was director of licensing, enforcement, and anti-fraud, if I had a consumer walk in my office and they have a home, and I know the home is worth $140,000. That's what it would cost to rebuild that home today, $140,000. And they walk in and they want $500,000 on it, or $300,000 on it. That should trigger to me that something's just not copacetic, because in 40 years, I never had somebody who really wanted to insure something for way more than it was worth just so that they could pay the premium. Okay? I mean, they may come in and say, you know, I think we ought to have 170 on it because of this or this or this. That's not a big factor. But when they go twice what it should take, that should trigger something that somebody needs to do some looking there. Okay.
Now, one more question regarding
Next page.
claims. One more question regarding claims, though. Let's suppose the municipality has changed the construction code requirements, or there's been a change in state law, or let's suppose there's now a green building code mandate by the municipality or so, and that exceeds the ability of the policy to respond. Would there be an endorsement that the policyholder would get that would allow for that increase in building costs?
Usually it's a standard provision for where policies automatically adjust for state changes in law.
And that's usually included in the policy language?
Yes, it's in in the insuring agreement.
There's a real life example here, and some of our member companies may have been impacted by it. When the Campbelltown tornadoes occurred, it was in August. Earlier that summer, the National Building, Pennsylvania had adopted the National Building Code just prior to that. And many of these homes had been twisted off of their foundations. And when bids were received, that included bringing the home up to the new standard, the insurers looked at their policy provisions. They did their pre-loss, their post-loss analysis. And a lot of policy provisions will say that changes to building codes are not necessarily covered in the loss. Now, what some home repair people did was they just never mentioned that that part of the work was going to be to bring the home up to compliance. A lot of that stuff had to do with egress, safety issues, and those kinds of things. So some people were being paid to bring their house back into compliance with the new codes. Other people were not, and for the department, I was actually out there with Diane Koken at the time when this occurred. It was a very, very interesting position that we were put in, because each company handled it differently, and each vendor that was hired by an insured handled it differently. And it's just one of those facts of life that you have to just deal with. So there are provisions typically in the homeowner's policy that address changes in building codes.
Mm-hmm.
But
In
changes
law.
in law are maybe a little bit different.
Yeah, definitely. I mean, if the policy, the reason the change of law, if they enacted a law that would have drastic change on 40,000 policies, do you really want these insurers to send 40,000 policy forms in to be amended? So that's why they use it. First off, it's not cost effective for the insurer to have to do all of that. Second, it'd be a huge drain on a department that's staffed with 190 people. There's just no way they would do it. So they use a standard provision for that. Building codes, that is another thing, because building codes can go by township ordinance, local ordinances, things of that nature. That's a little bit different than a state law. Yeah.
So we're at that point in the in today's course where it's opened up for questions from anybody here. So I'd like to if you have any, you can chat them to us by using the little messenger function at the top. If not, why don't you give a good closing statement, and and then we'll cut and run.
Okay. Well, if there's one thing you want to remember, it's the gambler's trade when it comes to an insurance policy. Okay. The synonym is DICE, D-I-C-E. Declarations, insuring agreement, conditions, and exclusions. They're the four primary components of a policy. They're the four primary components in every insurance policy, and all it is DICE. So that's the easiest way to remember it. Declarations, insuring agreement, conditions, exclusions. A lot of folks will say, what happens to endorsements? An mandatory endorsement becomes either one of the conditions or exclusions once it's approved, filed and approved, and put in use. So it doesn't actually become a separate section. All it does is amend one of the other sections of the policy, or even the deck sheet, but it may amend the coverage. So that's what that is. If there's no other questions, nobody? Thank you much. Hope you have a little better understanding of policies and how they can whizzle through the time frame. Have a good day.
Thank you very much. You'll be receiving notice of the next session 3, which is scheduled for January 21st, same time, and we look forward to seeing you folks. Thank you very much.